This is InvestTalk. Independent thinking, shared success.
Hi, thanks for taking my call. Wanted to get your take on Cisco, ticker CSCO. Do you think it's a good time to get in? Thank you. Bye.
All right, looking at Cisco Systems, they make routers, switches, networking equipment. They've been around for a long time, and their business is fairly consistent. Although last year earnings did fall 4%, this year earnings are supposed to be roughly flat and then go up about 7% next year to $3.99. Now those estimates for this year and next year are going up, so that's a positive. And obviously with build out of AI infrastructure, you need switches, routers, all the type of equipment that they typically sell. So they've done well typically during this time, but the question is it's ran, and is it ran too far? Okay, let me pull up a chart because that will be a good tell right now. So this has moved at bottom about $44 back in August. Now we're up to $64. And it did have a nice move higher in, let's see, what date was that? February 13th. And it's just been consolidating since, has pulled back kind of the 20-day moving average. The technicals are absolutely fine. The momentum is certainly there. So I give the technicals probably A minus, somewhere in that range. You're good there. Now let's look at the fundamentals. I talked about the growth, pretty meager. And if you look at the multiples, trading about 18 times earnings. Okay, if you look on forward-looking earnings of about $4, you're talking about 16 times earnings. Not bad. Not bad. They have minimal debt on their balance sheet. Free cash flow about 12 billion, almost 13 billion. So on an enterprise value of 265 billion, that's roughly 4.5% free cash flow yield. Not amazing, but not terrible either. Enterprise value to EBIT, that is high though. That's around 23. That's the highest it's been in a while. Let's go look at enterprise value to EBITDA. That's around 18. And that also is high as it's been in a while. So, the question for the market is this move sustainable? Once again, analysts are upgrading earnings momentum, and that's been positive. I would say now, though, it's a bit overvalued. So this is just a momentum play. It's once again, it's moved. And will those fundamentals catch up with this value? That is the main question. That's what the market is pricing in, an acceleration in growth. If that growth materializes, then, I think that momentum can stay relatively positive. If it does not materialize, this will have a setback. Multiples will contract, probably down multiples into the low teens, maybe even the single digits. And then you probably will reverse a lot of that gain. So certainly good company, 20% return on equity. That's very good. Good balance sheet, good cash flow. I have no problem with the company, but I think you might have missed it unless this continues to surprise to the upside. And there's already a lot of good expectations built into the current price. Thanks for the call.
Hey, Luke and Justin, Bill from Philadelphia here. Calling about Double Verify, ticker DV. They had earnings the other day, and the stock price slipped about, I think, 36 to 40%. And was thinking of picking some up. Because back in my marketing digital days, Double Verify was used to make sure fraudulent clicks and impressions didn't happen. So I like it as a third-party software tool. Fair value, I'm seeing probably around 22 to 24. Could be mistaken. Would love to get your guys' thoughts on that as well. But basically wanted to see if this would be a good time to pick some up. I know it's a good company, small cap, and it could be something that grows into a large cap over the years. Love what you guys do. Looking forward to hearing you guys. Thank you.
All right, looking at Double Verify, a name that went public in April of 2022. Okay. And it was kind of bouncing around for some time between, let's call it about $20 all the way up to about $42 for a couple of years. And then it broke decidedly lower back in, when was that? February of last year. So call it about a year ago. And that was at a high around 42. And now we're at $14 per share, kind of all-time low here. And that's because the earnings picture has become a lot more difficult. Earnings expected this year are only supposed to go up 5%, and they dropped 22% last year. So going from 41 cents per share in 2023 in earnings down to 33 cents per share this year. And analysts continue to downgrade estimates for this year and next year. So the trends in earnings estimates continue lower. And last quarter, revenues were up 11%, but earnings were down 32%. For the current quarter, estimates are revenues up 9%, but earnings down 87%, down to 2 cents per share. So what you're seeing here is their pricing power looks to be shrinking, and their margins look to be shrinking. And that is the problem, okay? And their growth is also slow, right? 9% revenue growth, that's not amazing. And so if you're looking at 33 cents in earnings this year, what type of multiple is that? That's still roughly a 40 times multiple. Okay. That's not great. Am I going to pay 40 times for a no growth business? Probably not. Now, price of sales currently is 4 still. That's not cheap either. Enterprise value to EBITDA is around 22. That's okay. Enterprise value to EBITDA around 15. That's okay as well. So it's getting there, but it's not cheap. Free cash flow has already dipped from 150 million to 132 million. And let me look at that was on an annual basis. And free cash flow last quarter was only 30 million. So it looks like it's topped out as well. So this is what happens when you have a high-flying name with great growth expectations, and those growth expectations are not met. It drops, and it drops considerably. It's already down 58% from its 52-week high. Typically, these things drop about 80%, okay, which would put this around the $10 range. That's probably where I would think about picking it up, is around $10. Right now, it's just consolidating sideways. I wouldn't be quick to pick this up, especially if it hangs around here in the mid-teens. That's an indication that this is just gaining power for that next move lower. But it is getting there to a reasonable valuation. The technicals need to improve, though, first. And major support won't happen until $10. Thanks for the call. Now let's play 2 in a row from 888-99 chart.
Hey, you guys. I was trying to call about ticker symbol CE. I think it's pronounced Celanese Corporation. Been holding it for a while. It's just going down, down, and down. So I was curious to know if you could please check on the fundamentals on this one. Perhaps you can advise me. Should I buy? Should I sell? Sure appreciate the show. Hope y'all have a good day. Thank you.
All right. Looking at Celanese, one of the world's largest producers of acetic acid and its derivative chemicals. And this is used in coatings and adhesives typically. And this has been around, I believe it was a spinoff. I think it was from DuPont, if I remember correctly. And the issue with this, and you always have to look at this with spinoffs. With spinoffs, they usually carry some of the debt with the spinoff. And many times with spinoffs, it's the parent company trying to unload debt onto this spinoff, right? They think their balance sheet is too bloated, but maybe this other business is doing really well and it can support that debt in the short term. But a lot of times that business can be cyclical. And when there's a downdraft in the economy or particular demand for their product, that debt can be a problem. And it looks like that's what's happening with Celanese. Right now, they have about $12 billion in long-term debt on a market cap of only $6 billion. Okay, free cash flow of $531 million, but their times interest earned is actually negative. Okay, so that's what's happening here. The market is pricing in a potential bankruptcy for Celanese, and that's what you always have to watch out for. Are those companies that are heavily indebted? Now, what I will say is, last couple of days, you're getting a nice reversal. This could be the low in Celanese. So I would probably be a bit patient on it to see if this recent strength on volume, and that's the thing, it's not just nice reversal. It's been on volume. That could be, and there's a sentiment indicator here as well. Your call in general is a sentiment indicator that, you're feeling the stress, you're feeling the pain, and you're not the only one. You're not the only Celanese shareholder that's feeling the pain. And so when you get these high volume reversals, that could be certainly a bottom for Celanese. Now, on the earnings front and a multiple front, it's pretty cheap. Right, earnings this year $5.70. Next year supposed to be $7.90. It's a $54 stock. So you're talking a high single digit multiple. So it's now cheap, but it has to get to a cash flow level and an earnings level that can sustain this debt. And obviously the market is a bit worried about it. If we get interest rates to drop, though, that might allow them to refinance their debt at a cheaper price and avoid bankruptcy. And so I would hold on to it for now. I would use this recent low. If it breaks below the recent low a couple days ago, I would be out of it. But as long as this high volume reversal can hold, I would probably hold it until then, because I do think there's a good bounce back potential with this name. That's Celanese, CE is the symbol. Now, we've been telling your friends about our podcast being available in video form, over on our YouTube channel. You can see all of our charts that we're looking at and get some more context of what we are saying each and every weekday. So let's answer one of the questions that came in the comment section over there. Arak Don says, you talked about CW, Curtiss-Wright, back in May, and I liked it, but wanted to wait until a pullback then. It just plowed ahead and now is pulled back a little. Seems fairly valued at a low 300s by my estimation, and wanted to dip my toe in. Seems like a very high quality, long operating history company involved in precision aviation, nuclear power engineering. Your thoughts on when to jump in? All right, let's take a look at CW, Curtiss-Wright. This is a name with about a $12 billion market value. And we have it's down about 17% from its 52-week high. Earnings estimates for this year and next year continue higher. You have $12.33 expected this year, $13.31 expected next year on a $323 stock. So certainly trading at a high multiple, but as you said, it does have a long operating history that is very profitable. If you look at return on equity, you're right around 17%. That's good. Not amazing, but good. And it typically is consistent in that range, high teens. So that's good on the profitability front. Free cash flow, about $500 million. So about a 4% free cash flow yield. Not amazing, but okay. Pays a dividend and plenty of room for that dividend to go higher. So I like that. What are they doing with that cash flow? They're buying back shares. I love that. And let's see, are they raising their dividend anytime soon? Yeah, they're continuing to raise that dividend as well. So I like that. Let me go take a look at the chart because yes, it has pulled back. Let me see if anything has broken technically on the chart. It just pulled back to the 200-day moving average. Nice little reversal today. The whole market kind of reversed. And if we can get above yesterday's high, I think that would be a good buying opportunity. And this is at the 50-day moving average, 50-week moving average, and that is good support as well. So yeah, I think this is a viable pullback on CW. Once again, great company, like you said, a very good business with nuclear engineering and many industrial markets, power generation, defense, etc. I'm going to give Curtiss-Wright CW a thumbs up. Now let's touch a bit on this changing world order that we are dealing with as investors and as citizens, right? And some may like it, some may not like it. Some may be on the fence. What you think, though, frankly, doesn't matter to the markets, okay? But it should matter to your portfolio. And oftentimes that can fly in the face of what you hope the world will look like. Okay. Now, there are three main questions that this should cause investors to contemplate. The long-term implications of a changing global alliance, a multipolar world, which we've been talking about was likely here. And now it's more in your face that it's here, but it's something that you should have been preparing for a while. Now, the immediate question, that's the long term. Okay, that's the long term, and you probably have a little more time to contemplate that. The short term, however, is what is the reaction to this, right? The tariffs, for example, likely to create higher inflation. What does the Fed do about it? And somewhere in the middle, you're talking about deglobalization, higher tariff barriers. That brings less efficiency to the global economy. Once again, that will have a short-term impact, but more medium-term as companies start to make shifts and there's more certainty around what the tariffs will be over the long term. Now, Goldman Sachs looks at tariffs and they think that the Mexico and Canada tariffs will add about 6 basis points to core inflation. 6 basis points. So if we're at, say, 2.4 now, it should push us up to about 3%. And that puts the Fed in a difficult situation. Do they react to that and raise interest rates and try to bring inflation down? When in reality, tariffs have nothing to do with really the strength of the economy. That's just a political decision. Or do they come to the rescue and say, that is stagflationary and we need to boost growth and push the tariff or push the inflation problem back on the president? I think that's what they're going to do. Because since Trump came to office, the odds of 3 rate cuts this year has gone from 4% to 38%. So that's where the market is pricing it. That's another reason why the dollar continues to fall. Now, in the long run, you have the geopolitical realignment. And this is starting to play out in foreign markets and currency markets. I said this before. The euro is getting stronger. European stocks are outperforming US stocks. Why? Because it looks like our government is looking to pull back spending, and those governments are looking to borrow more. They're planning to raise hundreds of billions of dollars to spend on military. So it's no longer the social welfare system that's going to take precedent in Europe. It's going to be military spending. So military contractors and ancillary products will be winners. And then when it comes to medium term kind of trade policy, global productivity will take a hit. And productivity is vital to a dynamic global economy. In order to have true growth, real growth, you need to get more out of the same inputs. That's what productivity is. And if there are now trade barriers, it makes efficiencies of markets far less. And that is once again, a stagflationary environment, which means the expectations for equity returns going forward certainly should take a step backwards. Now, once again, this is a fluid situation. It's not something that you can say today, you do X, Y, and Z. But you have to prepare your mind on how to analyze the incoming data. Once again, both short, medium, and long term. And what is important. And hopefully that's a start to how to break down the incoming data and start implementing changes in your portfolio. Let's go take a live call. Bill from Northern California wants to know about SWK, Stanley Black Decker, listing on AM 1220 in the Bay Area. Bill, do you own Stanley Black Decker, or are you looking to buy it?
Well, to be honest, I just did buy a small position. I think forgot what day it went through. About just under 80, right around $81 or just under. Kind of starter position. I like it for the dividend. I kind of thought I'd get some and then keep an eye on it. But I'm kind of curious about debt levels for them and just a general financial overview.
Yeah, that is a worry. They do have pretty good amount of debt, $6 billion on a about $13 billion market cap. So, it's not in distress or anything like that. But times interest earned is only about 2.3. We like to see 2 or higher, so it's higher than that. But it's banging on the door of potentially going below 2. So that's a bit of a worry. Free cash flow did go negative for a period of time, but it's back up to $753 million. That's good. That dividend, don't expect that dividend to go up or anything like that. Payout ratio is very high. That's why the dividend has stayed relatively static since 2021. So that's not going to go up. And they likely are going to continue to use that cash flow to pay down their debt. And that's probably the smart move at the current time. That's actually what they've been doing. June of 2022, they had $11 billion in debt. Now it's down to $6 billion. Okay, so they've taken a lot of that cash flow and whittled it down. So that's a good thing. I think they're doing some smart things on that front. But that dividend's not going to go up. They do, if things turn for the worse, this range that it's been trading in between, let me pull up a chart here, between, let's call it $70 and $100, it will break that. And it's been consolidating in that range. So that is a bit of a worry that if I pull out to a monthly chart, this is what we would call bearish consolidation. However, that's over the long term. Over the medium term, it did have a nice reversal back. What month was this? This was July of last year. And it's been consolidating that as well. So that's actually short-term bearish. So you have some conflicting, kind of very neutral setup here. Could really go either way. And it's all about how can they sustain this level of free cash flow, $600-700 million, to pay down that debt, whittle down that debt over time. If they can, then I think it's going to power to the upside. But if they take a turn for the worse, for whatever reason, maybe it's economically, right? If you get some sort of recession, this could be a casualty of that, because obviously their business is selling tools to people that are in construction. And so if construction suddenly slows markedly, the demand for their products could shift as well. So certainly elevated risk here. I kind of like the risk versus reward, to be honest with you, because of the history of profitability, of good cash flows. But once again, it's not without its risk. Thanks for the call. Now, Leslie, let's talk about housing and the fact that housing is likely to stay expensive for some time. Why is that? Well, people are stuck between fixed supply due to the locked in low mortgages and the fact that the demand really remains consistent, even with high interest rates. Okay. And owner's equivalent rent continues to stay elevated. So what was interesting is a couple of years ago, the supply of new multifamily homes was coming on board. And there was a worry that there was too many, right? That the developers built too many during the pandemic and it would be oversupply. But what you're actually seeing right now is that that's turning back to the upside. That owner's equivalent rent is actually reaccelerating. And this is going to feed in. This is telling you, this is a signal that supply remains tight and will likely stay that way until there's more building, really. And so lower interest rates is not going to help very much. If you think somehow the mortgage rates going from 7 to 6 is going to solve the affordability crisis, it's not. It's going to need more supply. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads. which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And remember, our second annual InvestTalk Market Madness competition is underway. You can enter and play over at investtalk.com, and you can win $1,000 if you come out on top. Keep in mind that we can also help you better understand your risk tolerance level and whether you can meet your long-term financial goals by heading over to investtalk.com and scheduling a portfolio review with me or Luke. Independent thinking, shared success. It's InvestTalk. Good night.